Welcome back. I wanted to talk about Oscar Health. They announced their earnings yesterday after the market closed, and today the stock traded up. And it traded up on a day when the market went down. That was really good to see. That goes to show that investors want to buy into Oscar Health. Now, the whole healthcare space has been sold off. It's not typical to see stocks in healthcare rally for a long time. They've actually been selling off quite harshly. Oscar Health had a good earnings report. I'm going to point out why I think it was a good earnings report. It had some trouble spots, and I'm going to point those out as well. Let's go over their earnings. Then we're going to go over their fundamentals, see what analysts are saying about them. I'm going to tell you about how desirable I think this business is, their moats, their competitive advantages, their ability to grow and grow their cash over time. And then I'm going to value Oscar Health and show you what I think the stock is worth per share and show you if it's discounted or priced at a premium. Overall, I'm an Oscar Health stockholder. So at the end of the video, I'll tell you whether I'm going to buy more shares, hold, or sell my shares in Oscar Health. So let's get into the earnings. One thing I always like to see is revenue growth, and Oscar delivered. They went from $2.2 billion in revenue for the quarter they just closed up to $2.86 billion. Nicely done. It's about 30% growth. Year to date, they've really expanded their business from 4.3 billion up to 5.9 billion. That is great. The one trouble spot is medical loss ratio did pop up substantially. They took a reserve, meaning they didn't pay anything, but they just took the reserve against the medical loss ratio and drove it up to 91%. That's what caused a lot of people to sell out of healthcare, specifically health insurance payers. The memberships, now this company focuses on selling health insurance to individuals and small businesses, and they're doing a really nice job of growing the number of customers they have. Really nice growth in customers. The income statement looks good. As mentioned, they took a reserve, they kind of took a loss, and they are operating with a loss in the quarter. When we look at the balance sheet, here's something I'll point out. If you add the cash on the balance sheet and you deduct the long-term debt, you get roughly $3.2 billion. When you look at the market cap of the company, it's roughly $3.7 billion. So you're getting this business when you take market cap minus cash for about $500 million. And when I show you the cash flow they produce, this year they're producing more than $1 billion of free cash flow. It is a really attractive proposition if you look at it through that lens of what the market cap of the company is and how much cash they have on the balance sheet. That cash they could use to weather this period where there's going to be some losses, but they can accumulate customers. And then when times are better, they're going to have a very large business. That is a really good long-term opportunity. As mentioned, cash. This is a $3.7 billion market cap company, and they're producing $1.38 billion of cash from operations. They don't have a lot of capex, 18.3 million. So almost all of it is free cash flow. That looks really good. So good that I'm going to use a lower number to do my valuation based on free cash flow. That number is just too big. It'll give me this gigantic valuation on the business. So that's the earnings. Overall, I thought there was a lot of good in the financial statements, and I'm guessing that's why the stock traded up today. The market cap is only 3.86 billion, while their revenue is 10.7 billion. So you're getting the company for less than one times sales. Analysts are saying sell this stock, get it off your books, and it's priced 15% too high. Well, I'll give you my opinion on that. Year to date, it's up 12.8%. Had a good day today, up 5.7%. It's really been volatile. At times, it's really jumped up. It just jumps up when investors get into the stock. When we look at the growth has been really, really good. And a lot of green on the screen. And they're going after a part of the market that they're not going to have a lot of competition. The competition is fragmented. If these guys could really grow in that space, they have a lot of addressable market. I think this growth can continue. And the cash flow is stupendous. When you have a business that's generating free cash flow early on, I pay attention. $1.2 billion of free cash flow in the trailing 12 months. That number is too good. I'm actually going to use a fraction of that, 0.75% of that number, in order to do my valuation. So that looks really, really good. Let's see what analysts have to say. 7 analysts cover the stock, and healthcare has been really sold off. Man, it's been horrible to see healthcare companies sold off, but that's the case. Right now, they're not popular. Analysts are giving out price targets, and on average, this stock to them seems to be priced too high. Looking at their forecast, they expect that in 26, their revenues are going to contract. I don't agree with that. I think the revenues are going to continue to grow. At the end of the day, people need health insurance. They're not going to do without it. And I think a lot of people that are in small businesses as well as individuals are looking for good health insurance. So I think their growth is going to carry on, and it's going to grow into 2027. And they are expected to be profitable next year. So that's going to be good news. Their profitability is going to expand faster than their revenue growth. That's also very good news. And their PE is really going to drop. Looking at some of their statistics, the RSI has gotten to 51.49. Today was an update, so it really pulled the RSI up. That looks good. Short sellers, look at this. Anybody in the mood for a short squeeze? Well, 24.56% of shares are shorted. If there's a move on Oscar and it starts to rally, these shorts are going to get squeezed. I think they're running a big risk because you're dealing with a business that has plenty of cash. They're growing and they're a small cap. You just get one big investor in here, or you just get enough retail investors in Oscar, and boy, these short sellers are going to be hurting. Let me talk about Oscar's moat and their ability to grow cash, grow profits. First, with the moat. Do they have a moat? I think they do. If they really focus on providing health insurance to individuals and small businesses, there's no dominant competitor there. So they can really capture that part of the market. When it comes to network power, they're small. So I can't give them much of a grade there. But overall, I think they do have that moat where they're building a good brand within the small business. They have a terrific balance sheet. And that balance sheet, I think, is going to be a strength so that they can take a few years to really grow the business and achieve great profitability in about 3 years. The revenue continues to expand by big amounts. I love that about Oscar. So that's why I put them on this side of the quadrant. Their growth is excellent. Their profitability can definitely improve, and their cash flow is excellent. So with that score, I put Oscar in the gray. They're a moderately desirable business, but they're not in the green, which is a highly desirable business. A company that has this type of characteristics, I want a nice, compelling discount. You got to reward me for taking the risk and locking up my capital in a company that is just moderately desirable. So I've researched the free cash flows that I expect the company is going to produce. I've also looked at their earnings per share, and I've valued Oscar Health, and I've come up with a stock target that is $35 per share versus the current stock price of $15 a share. So it represents a 57% discount available on Oscar Health. I got there because their cash flows are really high. I'm using a higher than typical discount rate, which should reduce the value of a business, but the cash flows of Oscar are so good that I've actually lowered them over time just to keep the valuation down and be more conservative. Overall, the net present value of that cash is $7.1 billion. They have a lot of cash on the balance sheet, very little debt. So when I add cash, take away debt from their net present value of cash flows, it's over a $10 billion value company, but their market cap's only 3.7. So if I look at the cash flows and see what they're worth and compare it to the current stock price, the cash flows are worth 64% more. When I compare the earnings per share of the future versus the current price of the stock price is discounted by 32%. Looks good two ways. And on average, or I should say blended, because I take more weight in the free cash flow method, 57% discount. That's a really nice discount on a company that is growing the top line, has lots of cash on the balance sheet, is proving to be a cash flow generator. I will be a buyer of Oscar Health. I'd like to own shares, and I'm in it for the long haul. It may take some time. Healthcare is really sold off. The market just doesn't like healthcare stocks right now, but I would like to own more Oscar Health. And I think I'm going to be rewarded over the next couple of years with this stock. Thank you for watching the video on Oscar Health. I hope you found my research interesting. I wanted to tell you about the paid member program with this YouTube channel. It gives you access to member-only videos, access to member calls, a Discord where we have members talk about stocks in the market each day, as well as on live streams. You can nominate tickers for me to review and drill into. Take a look. If you go to the home screen of the YouTube channel and you look for the join button toward the bottom of the screen, you'll be presented with the 3 different options. See if one's right for you. I'd really appreciate that. If you get signed up, please email me at victorhinvesting@gmail.com and I'll get you set up with all the perks. Thanks for watching. Good luck with your investments.